rail transport, we say that it is governed by what? The CMI convention. Okay, and then the limit of the liability is 17 special drawing right. When it comes to the forwarders, the carrier's responsibility as liability when he's using the road transport, okay, road transport. So here we'll talk about road, transport operators. They actually operate under the what? The CMR rules, okay, the CMR rules, and the special dwelling rights of 8.33 is their limit of liability. For ocean, the carrier is actually being governed by an international convention called the Hague-Visby Rule. We also have the Hamburg Rule. So we have the Hague Rule, the Hague-Visby, and then the Hamburg Rules. These things have been expatiated in your maritime transport model. Also, when it comes to the air is being governed by Montreal and then the Warsaw Convention. When you use the Warsaw Convention, you are talking about a special dwelling right of what? 17, equivalent to $20 US. And the same thing applies to what? The Montreal Convention. So these ones are the international transport conventions for the various modes of transport. So contractually, every country has their national, standard trading conditions that they use. So that one also is applicable for what? Contractual liability. And the standard trading condition has a limit of 8.33 special dwelling rights or other. So these are some of the things that, we have learned in maritime transport, but this one also gives you more overview that these things is actually used to determine the liability of a carrier based on the particular unimodal transport system that they are being implemented. So based on the definition of multimodal transport, a multimodal transport operator assumes responsibility for the performance as a carrier for more than one mode of transport. And as such, the multimodal transport operator bears the liability for the entire transport according to the contract with its merchant or customer. So this takes us to the end of liability insurance topic, and we shall look at the other topics later on. Thank you. Transport insurance. Under this topic, we try to expose the students to the legal issues about cargo transport insurance. The students should know the various forms of transport insurance policies available, some specific type of cover, and the interrelation between the covers in respect of risk coverage and exclusion criteria. Now let's go back to look at the cargo insurance policy, also known as a blank endorsed. Every cargo insurance policy, cargo can be transported across modes, various modes. And all the various modes has got their peculiar international conventions that they use. And this specifies the contractual liability. And it also set out the limit of liability, which are mandatory applied by law. So when it comes to the rail transport, it is governed by the CIM And then the sea transport, that's maritime transport, is regulated or governed by the Hague-Visby. And then the road transport is governed by the CMR. The air transport is governed by Warsaw Convention and then the Montreal Convention. And then we also have the national trading conditions, national standard trading conditions for the particular countries. And these things automatically set out the liability of the carrier based on the transport mode that is being used. Now let's look at types of cargo insurance policies. There are two main types of cargo insurance policies depending upon the size and scope of the shipper's operation. The cargo insurance policy can be in the form of an open cargo policy or a facultative policy. So a facultative policy is known as one-off or is a special marine policy which covers only single shipments, and that's all. Every risk discussed separately and a premium agreed upon. This policy provides the same coverage available under open policy. However, it does not provide automatic coverage because it is covered a single shipment. And if there's another shipment, it's not automatic. You need to start all over again. Once shipment has been completed, the coverage also ceases and the policy automatically terminates. When it comes to open policy, cargo policy are the most usual type of cargo policy around, where a policy is drawn up to cover a number of consignments, and they are often used when shipper has continuous flow of goods being shipped over a long period of time. The policy can either be specific value that require renewal once the insured amount is exhausted, or a permanently open policy that will be drawn up for an agreed period, allowing any number of shipments during that time. So that's the difference. The facultative is one-time, one-off policy, covers one single shipment, and the policy ends automatically when the shipment is completed. But in the open, it can be rolled over. It is continuous based on that period of time that has been stated, and then not just one particular shipment. Every insurance policy has an insurance certificate, and insurance certificates are often for convenience purposes. It is issued as evidence of the existence of the policy. In that certificate, the most important particulars of the recipient are mentioned, such as the lump sum, the goods shipped, the other means of transport, the journey, the condition of insurance, and what is to be done in the event of damage are all spelled in the certificate. This certificate may be co-signed by the authorized agent or the insurance company. In this case, the certificate is sometimes called the underwriter's certificate. I told you under the principle of insurance that insurance cannot take place when there is no insurable interest. So in cargo insurance too, there must be an insurable interest, which is a basic requirement for every contract of insurance, unless otherwise it has been waived. So who has the insurable interest? In an export transaction, it is either the buyer, the seller, who has the insurable interest in the goods in transit. So based on this, arrangements will be made with regards to the Incoterms that will be used. And then it will reflect the passing on of the insurable interest from one person to the other. And the insurable interest will also mean that you are carrying the liability. So as the question as to who bears or who has the insurable interest determines how the trade terms, okay, the internationally agreed trade terms are actually used to actually separate who at which point bears the insurable interest, who at which point bears the liability and all that. It is not necessary, however, for each party to take separate insurance cover. One party should always take out the cover on a warehouse-to-warehouse basis, and in certain conditions, will cede or assign the policy to the next party. So once the Incoterm is used, we know at what point that liability or responsibility is transferred from the buyer to the seller. When we talk about a buyer have an insurable interest in goods, not only as the owner, but also in some cases as risk bearers or as unpaid sellers having security right. Until they have divested themselves of all rights and duties regarding the goods, the person who has the legal ownership of the property has an insurable interest in that property.